At Kotak Mutual Fund now joins us. Harsha, good morning. It's been a tough start to the new year. The big question that we are asking is this market now at a risk of seeing redemption from retail? Last year, all through we saw retail supporting the market. Mutual funds invested a lot of money in stock markets. Do we have any evidence to believe that that could be turning because of the way the market has behaved?
No, clearly the money flow from retail domestic investors continues. But compared to, say, calendar year 2015, until November, the average run rate per month was about 6 to 7,000 crores of inflows into equity mutual funds. December was slightly muted. It was around 3,500, 4,000 crores. Similar trend is being witnessed even in January. So I don't think it has turned negative at all. Just that it has got tapered a little bit. Good thing is, out of the 6 or 7,000 crores that we were getting every month last year, about 2.5 to maybe 3,000 crores was coming through SIPs. So that money still continues to be there. What would have got tapered is a little bit of lump sum investments that were coming almost every month. So there may be some wait and watch there.
Okay. Harsha, hi, good to see you in today. In terms of our markets in particular for 2016, at least maybe in the first half, which are the key triggers that you would be watching most closely? Would it be, for example, the budget, earnings season, global, and the priority in your sense?
So I think domestic factors clearly seem to be lacking. The only domestic factor that one could look at would be any recovery in earnings growth. That is also unlikely to be seen in this earnings season. So maybe next quarter, if there is some improvement, maybe people will be excited by that. Other than that, I think one needs to look forward to some amount of stability in the currency markets and other global markets. If that were to happen, maybe we will find a bottom somewhere there.
Okay, but Harsha, this market has struggled for leadership all through last year. Banks have collapsed, and that's been the big reason we have seen this kind of collapse in the large cap index. You have ICICI, Axis, the bluest of blue chips falling 40%. How should one approach this particular space?
On the banking sector, we are still cautious. Clearly, over the last several quarters, we have been underweight on public sector banking sector. We were also not so positive on the corporate lending private sector banks. So most of our weight was in retail focused private sector banks, and that positioning is still continuing because the other segments still have issues to contend with in terms of bad assets as well as inadequate capital, etc. So I think this is a good time for retail-focused banks which do not have any of these problems to actually gain incremental market share, and that's what we are betting on currently. But as far as the banking sector itself goes, we continue to remain underweight.
Okay. Would you share the same feeling about NBFCs, which are largely more insulated, or rather much more, their gross NPLs are much better rather than the PSU banking space?
We do not have much of NBFC stocks in our portfolio. Whatever we have are again consumer-focused retail NBFCs. So we continue to believe that that space is still showing some growth, and asset quality issues are also manageable there.
Okay, Harsha, among your large cap holdings, you have Infosys and HDFC Bank as the largest holdings, and to be fair, they have done well. Do you think some of these stocks can still provide a bit of hiding space, maybe large cap IT, maybe the better quality private sector banks?
See, I gave my views about retail-focused private sector banks. So HDFC is definitely one amongst them. So we'll continue to remain positive and expect that they will continue to gain incremental market share, and hence they will continue to outperform the market. As far as IT sector is concerned, clearly you have to be a bit more stock specific. I do not think that all the stocks in the sector will perform equally. We have been focusing on a couple of stocks in the IT sector where we believe at least the business momentum has returned back, or maybe there are stock specific improvements that have happened, and that should add to a little bit of better growth compared to the industry as well as the market. That's where we are focusing currently. But as a sector, IT also continues to be an underweight because we do not feel that the entire sector is going to have higher growth than the market anytime soon.
Okay. What about Maruti, Harsha? Because you may not want to give buy or sell recommendation, but since it's a large part of your holding, I just want to understand how should you approach a stock like this in this environment where we have seen the dollar-yen equation change quite significantly.
See, most of the stocks we will not be looking at one event or one trigger as a focus point. Definitely there are other business fundamentals which are driving Indian automobile sector. The four-wheelers have seen a significant positive momentum over the last couple of quarters, and we continue to believe that with 7th pay commission rollouts happening most probably in this calendar year, that momentum should continue. So we continue to remain positive on urban consumption, and hence we continue to believe that some of these stocks will outperform.
Okay. Harsha, you don't seem to have much of a holding in pharmaceutical stocks. Even a couple of the nifty stocks are not in any of your portfolios as per my reading. Is that because of the US FDA risk and hence you stay away?
No, it's more to do with the high level of valuations that the sector is attracting even today. Despite correction over 2015, the sector continues to be trading at one of the highest valuations if you consider last 10 years average. At those valuations, there is absolutely no margin of safety. Even if there is a small regulatory hiccup, the stocks can really underperform. And we have seen that happening in a couple of cases in the pharma sector already in 2015. That risk continues to be there, and if the regulatory issues are not resolved in time, then the profitability also gets delayed or completely missed out. So these are the concerns which are playing in our mind, and hence we continue to remain underweight on pharma at these valuations.
All right, Harsha, thanks a lot for your time and talking to us. Always good to get your views. So that's the view from Kotak Mutual Fund.